Hey, good evening, folks. It's David Howes here from the Property Factory, and thanks for joining me for tonight's market update webinar and new project release webinar on Christchurch. Just as a bit of an audio check, if you don't mind, just popping in the Q&A box that you can hear me okay, or the chat box. That'd be good just to know that the volume's good, so we kick on into it and start on time. So if you don't mind just giving me a message through there, that would be much appreciated. We've got some messages there. Yep, cool. Chantel can hear me, great. Okay, thank you. So we'll get started. And obviously we've just got people logging in because we're right on 7 o'clock now. But the purpose of tonight's really just to drill specifically into Christchurch, as we've done, quite often in the last year and a half. But really to touch on some of the new market updates, some of the infrastructure projects that have completed or are close to completion, and then just to give you an idea of a couple of recent project releases, and also some of the things that are in the pipe, and to talk more broadly about the northern, southern and western motorway projects, which are pretty significant for Christchurch. More than $1 billion worth of roading going in there, and a lot of that stuff starting to open up now in stages and throughout 2020, 2021. So tonight's a good opportunity just to give you some visuals on that, and so you get a bit of a feel for the lie of the land. And at the Property Factory, certainly Christchurch has been pretty big for us in the last 12 months by way of projects and investment. And interestingly, 85% of the Property Factory investors who are buying in Christchurch from an investment point of view don't actually live in Christchurch. Big chunk, certainly Auckland and Wellington, but a number of investors from all over the country. And tonight's really about touching on some of the fundamentals and recent updates as to why. But it's just quite simply from an affordability point of view, from a long overdue for growth, which we've started to see in the last sort of 6 to 18 months point of view. And quite frankly, you can buy brand new property, fully geared. There's positive cash flow, it's self-funding, which really does make it affordable when run under management. So, just to remind you that everything we do, we include property management costs. Of course, if you manage it yourself, well, you're going to increase your cash flow further. But we build all that stuff in. So when we talk about properties being fully geared because of equity in other properties and producing $1,000, $2,000, $3,000, $4,000, $5,000 a year in cash flow, that includes those management costs as well. So just going to, just touch on a couple of examples around that tonight. So thanks for getting here on time. And as we go through the webinar tonight, if you've got questions, try and use the Q&A box if you can. Type them in there, and I'll make sure that whoops, I can go forward but not backwards. Let me just jump back there. Use the error. Yes, as you got questions, type them in, send those through. And my name's David Howes. If you just jumped on, Campbell's away with his daughter on the west coast of the South Island tonight, and he's been on a bit of a school holidays fun. So I'm stepping in for the webinar tonight. And as I said, make sure that if you've got questions, just type them in, send them through, and we'll touch on those as we go along. So tonight's about Christchurch. As I said, a bit of an update on some of the recent projects that have been completed, as well as what's in the pipeline. Some of the things we're seeing growth and cash flow wise, and a bit of a walkthrough of some of the newer projects. So we've had a lot of people join the Property Factory in the last 2 to 3 months. And so for those of you who are regulars and know the background, great. I'll jump through the intro as quickly as I can. For those that are recently new to the Property Factory, welcome along. And just by way of introduction, just to explain what we do, because sometimes people get to the end of the webinar and they say, "What do you guys do again? And how much does it cost? And what's it all about?" And so the Property Factory itself was founded by Campbell Vetting a decade ago now, and was really designed to, on one hand, provide a solution for developers, builders, vendors who build great properties across the country, and on the other hand, do all the analysis, all the research, valuations, rental assessments, cash flows, etc., all the DD or due diligence around a project to make it easier for investors to understand, does this project make sense? What are the fundamentals? Is it good to invest in? Why or why not, etc., etc. And so 2 years ago, about 2.5 years ago, we then set out to say, okay, well, how do we take a traditional business that had a great reputation? How do we digitize that? How do we put everything online for our members who often spend more time in the evenings and weekends looking at projects than during the week? How do we make it easy to get access to everything 24/7, and so that investors can look at projects across the country with a consistent view and with consistent analytics, as opposed to you go to Trade Me and it's listed one way, and you go to Harcourts and they do one thing and Railway does another thing, and nobody really provides all the information. They have this old-fashioned real estate model called call the agent if you want anything, and then you call the agent and half the time they don't get back to you, so that you end up getting I call it buyer fatigue, and you just kind of give up. So the Property Factory makes it easy for our members, and membership's free in case you're wondering, to access excellent projects across the country that are brand new. We critique 10 to 20 projects for every one that we list. We're a licensed real estate agency. We're paid by the vendor a marketing fee for any project sales, just like Bailey's or Ray White or LJ Hooker or what have you. The difference with a Property Factory was we're paid by the vendor, but we work for the buyer and bulk sourcing stock, doing all of the analysis, all the research, and making it easy for you to not put all that kind of all that legwork into trying to work out what makes sense and what doesn't. So that's what we do. And in total, across the last 25 years, through the Property Factory and previous businesses, collectively we've transacted more than $1 billion worth of real estate across New Zealand. And if you add up the years of time in the market, by Campbell, myself, and the balance of our team of about 12 or 13 people now, it's about 125 years between us. And I guess when we're both in our early 50s. When you've been through 4 property cycles as an investor, as a business person, you see both sides of the market. You see ups and downs. You see the good and bad and the ugly, and it gives you judgment. It gives you experience that really helps you to make better decisions going forward around projects and property. So in terms of what we do, and we're very location focused. We believe that if you time your entry into the market at the start of the next upward growth phase, and we'll come back to the property clock shortly, then you're more likely to build your portfolio faster if you enter the market at a point when it's growing at 5, 6, 7, 10% a year, rather than it's in the middle of a very, very long flat phase or correction after a previous growth spurt. You're more likely to grow your portfolio faster if you get into the right location at the right time in good quality projects where there's a story around them that makes sense in terms of driving growth. So we talked a lot about infrastructure plans, but when there's motorways, schools, stadiums, new retail precincts, employment going into areas, then they drive demand. They drive demand for tenants. They drive demand for property. They drive values up, and they create great places to live and great places to own property from an investor's point of view. So the infrastructure story is really important, because otherwise, if there's no growth, nothing changes and things go sideways. And what you don't want to do with real estate is buy in a market where there's no investment and there's no population growth, because if that's the case, then why will rents rise? Why will values rise? Why will people move there? Why will you get capital growth? Those are the things you've got to ask yourself. And historically in New Zealand, because of higher interest rates, often when we needed cash flow, we had to go to the secondary markets or the regions, and we're now in an environment today where we can buy brand new property off the plan, no maintenance issues for the first 5 to 10 years. That even if it's fully geared, i.e. we borrow 100% of the money because we have equity or security in another property that we own, that those properties are self-funding from a cash flow point of view. They attract good quality tenants. They're well designed. They've got good 20-year long-term histories of capital growth performance. And when we combine that with making sure they attract the right tenants in the market at the right time and wrap experience and judgment around that, that helps to provide projects to our members who are investors and in some cases first home buyers, that helps them get into good projects, good properties that make money. And fortunately, because of our time in the market, we understand the difference between experienced developers that are well funded or well capitalized, versus developers that are new to the market that aren't well funded. where the project might take longer, it might stall, it might fall over, or that developer through lack of track record might cut corners, take shortcuts, et cetera, et cetera. And so for us, it's as much about choosing the developer and looking at their history, what they've produced, what they've built. Did it match the quality and design they promised as part of project selection, as opposed to, hey, Johnny, the first time developer selling a property, hope like hell he builds it in 2 years' time and hope the quality is good and that he doesn't run out of money. So all that kind of stuff is important in the background with new projects because of course, there's more moving parts as opposed to an existing property that you can see and check and, boot the tires and find out, firsthand what it looks like. So a lot of what we do at the Property Factory is providing projects that you can purchase off the plan. So in some cases, so probably right now, about 10% of our projects are built, sitting empty, ready to go. Like, so take Colombo Street, for example. Great project and filling up as it sells. But if you think about buying off the plan from a different point of view, which is something that's been quite a new concept for New Zealand investors in the last 5 to 10 years, mainly because interest rates were higher and new properties weren't as affordable because the returns didn't make sense, but home buyers have done it for a while. But here's the concept, right? So right now we've got projects on the website that settle late 2021, early 2022, even right out to late 2022. So what that provides is the opportunity to purchase that today off the plan, pay a 10% deposit. You're purchasing at today's price, and that price is locked in on your contract. And then essentially, all you have to do is come up with the other 90% at settlement in a year, 18 months, 2 years' time. Now, in that time, if you've bought into a rising market like Christchurch or like Auckland right now, then by the time you settle that property, it may have risen in value 10, 20, 30%. So giving you a nice equity kickstart before you even sell the property. For developers, of course, the issue they have is they're selling it at today's prices. It's an empty parking lot. It's a 2-section side-by-side with a couple of 1950s houses on that they're going to bowl over and replace with 12 brand new townhouses. It's some other building they're going to tear down. Their risk is you'll pay today's prices and they have to build it in tomorrow's dollars in 6 or 12 or 18 months' time. So they take a lot of that risk. You put down a deposit. It goes into a solicitor's trust account. It's protected. The developer can't touch that money until code of compliance is issued and until you settle and until your pre-inspection of the property is done. Then no money transfers to the developer, and that's legislated in New Zealand. That's not a case by case. And so, what we do is help to bring you those types of projects where you can make gains while you sleep, based on having your foot on the property, i.e., it's under contract, but not necessarily settling for 1 to 2 years. So it's a common capital growth strategy in a rising market to increase equity before you settle. If you apply the same strategy in a market which has had 4, 5, 6 years of growth, so think about Wellington or Hamilton right now with strong growth runs now since 2015, then the risk you have in a market that's already been growing for some time is if it reaches the end of its growth phase and levels off, then by the time you settle in 12 or 24 months, worst case scenario, it's gone sideways and it hasn't risen in value. That's best case scenario. Worst case scenario is maybe if you, for example, in late 2014, you bought an off-the-plan apartment in a rising Auckland market, and by the time you have to settle in 2016, the market's leveled off and values have dropped maybe 5 or 10% in the apartment sector because of oversupply. Worst case scenario, you can end up settling a property that's worth less than you have to pay for it on paper, if that makes sense. Hence, the rising market is really important, and understanding the property cycle, because what we want to understand with any property market is where is it at? Is it just started its growth phase? Is it well advanced in the growth phase, or has it been flatlining or adjusting for some time? And so, with every project that we list, we work out where that suburb and that city is on the property clock, and we make that information available through you to the website. And what happens is, if you take a market, let's take a market where you've got rising sale prices, rising volumes, etc., etc. So let's take Hamilton or Wellington that we can debate where we think the market is, but we can't debate that they've been growing for 5 years now, and pretty spectacularly. So what happens is prices rise, there's more construction, there's more stock available, and you get to a point where prices might have increased 80 or 100% in 5 years, but rents have only gone up 40%, and incomes have gone up maybe 30% or 20%. And so what happens is affordability becomes an issue, and unless interest rates keep dropping, of course, then prices peak. The market starts to reduce volumes. We can end up then with stock sitting around, or we get an oversupply type situation. Developers have built all the stock that they now can't sell, or they're halfway through building it. They have to start to take some price discounts to sell it. As a result, less construction occurs, and we get to the point where there's a nice, happy equilibrium between stock available and stock being constructed and prices. That adjustment kind of bottoms out, and then we go back into a market where there's not enough construction, undersupply starts to occur, and before we know it, more people fighting for less properties, up go rents, up go prices, and away we go again. And that's kind of a crude version of the cycle, but the share market sits in there somewhere as well. And of course, a massive overlay that's always important is population growth. Right now, in New Zealand, we have record numbers of expats returning from overseas because of COVID-19. We have limited numbers leaving. That combined with low interest rates is creating the perfect storm by overlaying excess demand, which is why we're seeing all these crazy headlines right now about the property market, about prices rising quickly and stock selling out and all that kind of stuff. And what we're seeing is we've got good stock supply in Christchurch, and rising values. In Auckland, we've got situations now where projects are releasing and selling out and selling out 70 or 80% of the project in less than 7 days in many cases. Not always, but in many cases, which was back into that heady kind of market. So just pulled this information today thanks to Lara, one of our lovely team that's based in Christchurch, and she did some research, and this is June 20 versus June 19. REINZ stats. In this case, it's a couple of months out, but you can see despite what we expected to occur, or some of the doomsayers who expected to occur in terms of a 20 or 30 or 40 or 50% market crash post-lockdown, you can see there year on year, double-digit growth through most of the country. Pretty healthy growth throughout the country. The other thing you can see there in terms of rental yields, I guess what really stands out to me when I look at this, if you look at Auckland and Wellington, Auckland and Waikato, yields in the threes, Wellington yields in the threes, Canterbury or Christchurch yields at 4.5. So the best cash flows in terms of capital cities, and when I talk about capital cities, I'm talking about Auckland, Wellington, Hamilton and Christchurch being the four biggest cities in the country, because we're still seeing rents rising quickly because of demand and capital growth, despite being there, not keeping up, which is creating good cash flow opportunities for investors. So at a major city level viewpoint, this information, if you've been watching us, hasn't changed in any of this year. Auckland and Christchurch just into that new uptick in the next market cycle of growth after Auckland going sideways for about 4 years, Christchurch going sideways for about 5 years with slow increases, and you can see there Hamilton and Wellington and New Zealand as an average having solid growth for the last 4 to 5 years. So if you take the South Island, you can see there, Queenstown and Wanaka, amazing growth from $500,000 to $1 million in the space of 5 years, right? So we all know that can't carry on at that pace without some correction while incomes and rents catch up. And that's what we're seeing now. And then if you overlay the Airbnb issues and the downturn in international tourism, you can see there's a few headaches and adjustment issues going on in Queenstown and Wanaka with more short-term stock or short stay accommodation coming back into longer-term residential tenants at lower yields, because those investors running Airbnbs obviously can't afford to have empty properties. We've got Christchurch there, going sideways and just starting to increase in that last year and a half. And then surprisingly, for the first time, I think, in history, or since records have been kept, Dunedin has overtaken Christchurch from a median price point of view. And you can see even Invercargill's been charging along from sort of around the 200 mark to around 350. So what that tells you is either in the next 12 months to 2 years, everybody from Invercargill and Dunedin will move to Christchurch because it's so cheap, or quite simply, due to population growth and increasing demand, prices will rise and there'll be an adjustment because rents are growing, yields are great, and obviously it's just gone through that extended flat period because of the post-earthquake construction period and everything else that happened in the last 10 years. So for us right now and for the foreseeable, 6 months plus, Auckland and Christchurch are still the outliers, but in terms of growth opportunities. But watch this space. We are in an unusual world right now, and if you think about the GFC and you think about the '87 stock market crash, the old saying is, the US sneezes and New Zealand, catches a cold. I think what's happened this time around, which is completely different with this pandemic, is it's a difference between the haves and have-nots in terms of who's managing it well, regardless of what you believe or don't believe about bloody hoaxes and all sorts of things. The reality is the countries that are managing it well, that don't have people scared to travel, scared to go out, dying in droves, etc., are going to come out of this faster than the countries that right now are crippled because of handouts and subsidies and hospital beds being full and so on and so forth. So globally, we've got this massive kind of pressure and all sorts of economic pain ahead. But if you think about New Zealand and you think about Australia and the Pacific Islands and the kind of bubble we're in, if we manage the virus well and we suppress or eliminate it, then that makes us doubly attractive globally for investment, for people with money moving here, for expats coming home, for all sorts of crazy things happening that we never thought we'd see in our lifetimes, that create this market right now where we are going to keep trucking along while interest rates keep dropping because of global issues, even though locally the economy is quite healthy, despite some of the setbacks we've had in the last 3 to 6 months. So, but these are my personal opinions and observations, supported by the data we're seeing and commentators like Tony Alexander. But these are things that's good for you to understand, because when you read those sensational headlines in the Herald or the New York Times or wherever, Sydney Morning Herald, it's good to sort out the facts from the fiction and some of the other sensational kind of headlines, because if you understand the structure of the market, you'll understand right now it's a buyer's market like it's a buyer's market like it's a seller's market like we haven't seen in a long time, but it's an investor's opportunity in terms of right now borrowing money at the lowest cost ever and getting the best differential between yield and interest rate. And in many cases now, we've got people buying properties at 5 to 5.5% yields brand new with interest rates half of that. I mean, if you're an investor and your rent's double your mortgage payments, you're pretty happy. Okay, so in terms of Christchurch, bit of an update on the major projects. It continues to storm along. So the convention centre worth almost $500 million, opening early 2021. And if you start to think about that from a global point of view, this is an international convention centre that's world class. And globally, if you're thinking about running a convention right now, where are you going to go? Miami? I don't think so. LA? No. London? No. You're going to start to think about where are the destinations that are safe for my delegates or my participants to go to. And so places like New Zealand and Australia will benefit massively off global decisions around safety and health. So just think about those things when you start to think about the world we live in and the part we play right now. It's pretty exciting. The Metro Sports Centre, that's still about 18 months away. But again, that's an amazing $300 million facility in the city, just across on the edge of Halsey Ave, and it's pretty centrally located and going to be a great facility. The covered stadium, still a little way away, but start thinking about that with when you're purchasing townhouses in the city. We just released a project on Monday, which we'll have a look at tonight in Gloucester Street. It's just a couple of 100 metres from the new stadium. So think about that from not even from a short stay accommodation point of view, but if you are thinking about buying property central to restaurants and bars and jobs and entertainment, then all those little things give it the X factor above something that might be 2 or 3 or 4 or 5 kilometres that you've got to stagger home to after the game. So, these types of projects, if you understand where they are in the city, help you understand the lie of the land and where the benefits are going to be. And even in Christchurch right now, there's two sides of the city that, one side going extremely well, the other side more easterly, closer to the water. The results and demand and growth isn't as good. So it's not all properties and projects are created equal. and not all suburbs are created equal. So understand the market. So the Christchurch motorway master plan is significant in the sense that when you put motorways into anywhere, or when you increase the carriageways from 2 lanes to 4 lanes, things happen, right? So you then go from saying, I don't want to live on the outskirts of the city because I can't be bothered spending 40 minutes in traffic to get to work, to saying, wow, I'll happily live in the country on a quarter of an acre or 400 square meters or what have you, because now I can get to work in 20 minutes. We've got a nice space for the family, the kids, the weekend. I'm close to the airport, etc., etc. So you've got this northern arterial extension that's coming all the way into the city, into the CBD, that's going to bring traffic in from the north and cut 10, 15, 20 minutes off the commute times. So if you just look at this simple diagram here, there's all this land out here that's green right now because it's horticultural or farmland. Right through into the close to the city, it's not very dense, and I'll show you an aerial later on, but right now it's farmland. And so start thinking about the impact of these types of locations to where you might invest, because when I can get from the city to the airport, or from out of the city into the city or into the airport in 20 minutes or 25 minutes instead of 45 minutes, then what starts to happen is people start living further out, larger houses, more land, etc., etc. So the Western Corridor, for a lot of people who live out north of the city but work at or around the airport, I think the airport alone employs 6,000 people, and then you've got all sorts of businesses that feed off that. They're now able to then, and this motorway is open now, they're now able to commute to work in 15 minutes as opposed to 25 or 30 minutes prior to the motorway when the old ring road was there. And this has been a $300 to $350 million project. The Northern Corridor, which is opening later this year, is a massive motorway that comes all the way from the northern end of Christchurch right down into this interchange here, just on the northern side of the city. $290 million. That's going to open up. And I don't know if you can see it very well, but there's lots of bare land either side of that motorway extension all the way down to the city. And so the government strategically, of course, puts the motorway there because guess what? You can build new houses, access to motorways, doesn't create congestion. And now that land, which was previously pasture or horticultural farmland, is now open for development and investment. So these things are good to understand because this drives change. This drives growth. This drives population growth. This drives people living and moving to different places, and it drives greenfields developments that if you invest in the right ones that are located well, that will then make sense investment-wise. And again, not all developments make sense investment-wise. Some of them are designed, or many of them designed for owner-occupiers or first-home buyers where the numbers don't stack up. So you've got to be careful that you don't buy over-spec'd, overpriced houses as investments and then find yourself losing $5,000 or $10,000 a year in cash flow. So in terms of Christchurch, it's just an incredible story, and there's so much to come because we really are just starting to get towards the end, I guess, of the first phase of that redevelopment where so much is now complete, but equally there's a lot popping out of the pipe in the next 1 to 2 years as well. So it's real and it's coming along. And so, as well as all sorts of new projects that are opening up and evolving as part of attracting business, attracting new head offices, and all sorts of things to Christchurch. So one of the things to always look at is a bit of a taste test, and I'll just jump on this before we have a quick look at this before we jump into a bit of a project update, is how fast have rents grown and how fast have prices grown? Because from an investment point of view, the simplest way to figure out when will the market come to an end in terms of capital growth in the current phase is to look at whether rents have kept up with price growth. Because if they haven't, guess what? Yields are falling because prices are growing faster than rents. Affordability is an issue because if you take Hamilton Central, which has grown in value 111% in the last 4.5 to 5 years, for most people, if their income had increased 15 or 20%, they'd be pretty happy in that time. So it's a sign that you get to the point where affordability falls and yields fall, that the market will start to level out while those things catch up. Of course, this has received an extended kind of, I guess, growth spurt because interest rates reducing over the last 3 years have made it easier to borrow more and more money and pay more and more for the property and still have the same cost mortgage. Of course, we all know that eventually, if there's an interest rate increase, if you're sailing too close to the wind, that can cause real headaches. at the moment, the outlook is for long-term low interest rates and falling because of the global issues suppressing interest rate growth, not because of anything that's wrong with the New Zealand market fundamentally. So that's again, that comes back to that unique environment we find ourselves in. So Wellington, highest income location in the country, lots of head offices, lots of public servants on nice big salaries. Wellington's seen, in terms of Wellington Central itself, has seen 60% growth in values over the last 3.5-4 years, and rents have increased 33%. So more than Hamilton in terms of rental increases, and obviously a lower rate of price growth. But you can see the yields are falling because rent growth is not keeping up with price growth. Christchurch is the opposite. We've had that prolonged stagnation with the reconstruction and all the disruption to the city post-earthquake, which has just started to change. You can see there on that graph, doesn't seem like much of an adjustment, but when 450, 460 goes to 500, that's a nice little 10% kick. That's just started to happen in the last 10 or 12 months in most suburbs. But we can see, because of the growth of the city, because of population growth, because of affordability, rents have actually risen about 48% now in the last 4 years. So yields are rising, cash flows are rising. So what follows, of course, is people go, this is great. I want to live here. It's cheap. I want to invest here because the cash flows are great. Income's increasing demand, increasing population, and then prices start to rise. Yields start to come back into line because the yields are artificially high right now, and you get your capital growth, which we're starting to see. I won't bombard you with data for Auckland, but if you just look at the 6 key regions in Auckland, we're favouring Waitaki in terms of the West Auckland region, and anywhere central to Auckland. So whether it's out south, Onehunga, Mount Wellington, Papatoetoe, where it's central to the airport, central to Manukau City, central to Auckland City, then those locations are favoured. North Shore, obviously a good growth story, but hard to get yields. Rodney, obviously further north. Papakura, a long way further south. It's easy to forget that that's 40 kilometres out of the CBD. If you look at Taotu Peninsula, it's 13 kilometres out of the CBD. Similar price points. And of course, Manukau keeps on trucking as a big city. So, West Auckland, we've got a lot of focus on that. And again, if you look at that, we can see rental-led growth. Rents are rising, yields are rising, cash flows are good. And if we just take Taotu Peninsula as an example, but one of many West Auckland suburbs, you can see they're just starting to get a little uptick just in the last 3 or 4 months in terms of data. So that's a bit of a I guess recap on how we look at the market and the latest data. I hope that helps to explain the drivers and some of the economics and some of the whys behind why you see so many Christchurch and Auckland projects coming out of the property factory. It's not that we're not looking for Wellington and Hamilton projects. It's just quite simply because of the data I've just shown you. It's very hard for us to get projects in there where the yields make sense. Buying projects late in the market growth phase, the price points have grown a lot in the last 4 years. And in most cases, cash flow negative, 1,000, 2,000, 3,000, 4,000, 5,000 a year. One of the things we released over the weekend for the first time was a pretty cool little commercial project. And I won't jump into that now, but in the Lower Hutt area where vacancy rates are 0.2%, price points of 300 upwards, and cash flows of up to $15,000 a year. But that's a different story, going out of residential into commercial, retail, industrial. So sometimes to get yield, you've got to change the strategy. Okay, so I'll quickly step through these 4, and I'll jump into the website, and then I'll give you a quick update, and then you can ask me questions along the way around any of the information or analysis or any of the questions you have about using our site that may or may not make sense or cause confusion at times. So this is a project in a suburb called Addington. It's only 4.5 kilometres to the CBD. We released it about 2 or 3 weeks ago. I just wanted to point out there's one remaining. It's a positive cash flow, $1,000 a year under management, property management, and it's $360,000. So if you are an investor where because of income or equity, you're struggling to buy property at $500,000 or $600,000 or $700,000 because of borrowing capacity, the good news is you can still buy stuff brand new in the mid 300s that even under property management is cash flow positive in great locations. So don't rule that out. And we always recommend as an investor that, you should be spreading your portfolio as it grows across 2, if not 3, if not 4 centres, so that you've always got at least 2 of your locations in an upward growth phase, as opposed to having everything in Wellington or everything in Auckland or everything somewhere else, where then when the market goes sideways, everything stands still for you for 2, 3, 4, 5 years because you're getting no capital growth anywhere, which means you've got to sit on your hands, which can be frustrating. So hence the philosophy. This project was released last week. It's in Gloucester Street. It's 750 metres to the Christchurch Cathedral. It's in the city. It's a stone's throw from the new stadium. There's only 5 out of 21 left, and it's positive cash flow to $1,300 a year. 2-bedroom, 2-bathroom townhouses. Yes, so Dave's asked a good question. Is the positive cash flow based on 100% lending? Yes, Dave, it is. So 100% lending, all of the costs, plus a generous 10% for property management. And so the net result after that is based on 100% lending at interest only. But in our cash flows, we also show P&I as well, so you can see the difference based on you having equity or security in another property. If, of course, you put in a 20% cash deposit and only borrow 80%, then, of course, your cash flow is going to increase because now you've got less debt. If you self-manage, of course, your cash flow is going to increase because you've got lower outgoing. So, yep, transparency-wise, all costs are in there, any body corps, any rates, etc., etc. And just on body corps, and often this topic comes up with people saying, oh, I don't want to buy a place with body corp, I'm sick of those body corp costs. Just think about body corp as shared maintenance and shared insurance. So the reason why you have shared insurance is, guess what? All of your properties are joined together at adjacent walls. So body corp provides insurance to cover the entire complex because, of course, if one starts a fire and burns the rest down, you need to have cover for the whole lot. So in any body corp cost annually, usually insurance is anywhere between 40 and 50% of it. And then the other half is just shared maintenance for gardens, lawns, common areas, rubbish collection, swimming pools or foyers and lift shafts if you invest in apartment buildings. It's just shared costs. So generally, those types of buildings have higher yields because of those costs come out of it. Always look at the net yield after costs to do a like for like. But don't be fazed by it. But equally, just be careful because there's some projects that are, elaborate $1 or $2 million apartments in Auckland and Wellington where the body corp's like $5,000, $6,000, $7,000, $8,000 a year. So it's a lot of money. And if you're an owner occupier and you don't care, that's fine. But of course, as an investor, that can become a real issue because just because you spend twice as much on the property doesn't mean you get twice as much rent. So just be aware of that from a like-for-like point of view. This project has been really exciting for us to release. We've been working on this for some months with the developers. They're experienced developers. The builder has got a 40-year history of residential house and land construction in Christchurch. This is in a brand new suburb called SILVERSTREAM. Well, it's a development called SILVERSTREAM on Greenfield's land adjacent to Kaipoi, northern end of Christchurch. It will benefit massively from the new motorway, and it's got a 440-bed, 5-story rest home being constructed nearby that will create a lot of employment in the area, and of course all sorts of people that want to live by or near to their loved ones, etc., etc. So we'll jump into that shortly, but that's a great project. What's exciting about that is $4,000 to $5,000 a year positive cash flow. All bar one of the 2 beds have got garages. They've all got 2 bathrooms. The 3 beds have also all got 2 bathrooms and a garage. They're on good sized pieces of land, and the price points are crazy. You only have to go a little bit further down the road, and you're paying $550 for the 3-bedroom houses, and you're paying $450 to $480 for 2-bedroom houses. So price points we haven't seen with house and land. And then lastly, before I jump into the site, we've got projects in Rolleston, an area that's had $290 million developed in its inland port and surrounding commercial area. That's selling at a great rate right now, and really starting to see catch up now in terms of growth, and it will benefit massively from that new northern motorway. So again, that'll be cash flow neutral. You can see the higher price point there, but that'll be cash flow neutral. But again, for those that want house and land, good quality properties. So just give me a second, and I will
quickly share the website. Right, so just jumping into the website. So I've just jumped into the members dashboard. If you're not a member, just go to join now and sign up. It's free. But in the members dashboard, I go into current projects, and in here is where, if you're a bit of a visual person like me, you can then quite easily see where our projects are by type in terms of house and land, etc. Or you can just search across the country if you want. You can just jump around based on what type of stock you're looking for and where you're looking for that stock. So one of the things that we recommend that you take advantage of is the ability to view projects by performance. Of course, we're always looking at the numbers. We're always sourcing projects based on the numbers. So if you don't look at the numbers, we'd be deeply concerned, because it's actually, a big part of it is about the numbers. So I just want to point this out to you so that you take advantage of it. But you can see there, when you go into the analysis area, we've sorted all of our projects nationally by highest net yield. So those commercial projects I talked about, some pretty healthy cash flows sitting up there at the top. The Kaiapoi SILVERSTREAM house and land projects have gone straight to the top of the residential pile in terms of those cash flows. Net yields of 4% after taking out costs. So if you think about borrowing the money at 2.5% to 3%, then you can see there net yields give you a lot of money to pay the debt cost. So we also analysed performance based on capital growth over the last 20 years, average annual growth, growth and yield combined, when you add the two together, and by lowest price point, so you can easily find the lowest price point stock in the country as well. So I'm just going to jump into the Kaiapoi project, SILVERSTREAM project near Kaiapoi, and you can see here that that is the aerial photo of the piece of land that it's been constructed on. You can see brand new, good quality houses all around it. Some of these are really big, 4 or 5 bedroom houses, up into the 6s and 7s and 8s in terms of price points. So big driver, that new retirement village going in nearby. You can read the stuff article on that on the website. And then, of course, that big motorway project that we talked about earlier. So that's going to then make SILVERSTREAM handy to Kaiapoi from a shopping point of view, handy to Northwood, handy to golf courses, handy to beaches, 20 minutes to the airport, 25 minutes to the city. So that's the real story around SILVERSTREAM and why that brand new subdivision ultimately will turn into its own suburb, I would imagine, as it grows over time. So if you're looking for house and land, great price point. If you're looking for growth, it's got a strong average, even though if you look at that over 20 years, it's grown 207%, even though post-earthquake, it's been dampened at 60% growth over the last 10 years. But away it goes again in terms of, you can see there that just starting to head off again with that upward growth cycle compared to the national average. So this is a pretty exciting project, partly because the price points are great, partly because it's well finished, well fitted out, well designed stock that that'll have great resale value. It's quite spacious in terms of the sizes. You've got 3 bedroom options that are 103 square meters, and on land that's around 200 square meters. You've got 2 bedroom options. We'll concentrate here. That all bar one are 85 square meters internally. The 65 is without a garage. The rest have got garages. And again, you've got nice land. And this project, that's an artist's impression, but it backs onto a reserve, and there's a stream behind that. Hence why it's called SILVERSTREAM. So really nice outlook if you think about a reserve as opposed to looking at your neighbours. And when you think about rentability, if you can rent properties to tenants who've got some outdoor privacy where they can sit out there, a bit of air outside, have a nice little backdrop that's green, not just someone else's back fence, it's pretty enticing. And you can see there the aerial shot on the left. That's the piece of land just right at the bottom of the screen here in the foreground. It's been built on. There's a stream there down the middle. You can see the various phases of the development over the back. And you can see here, this is an actual photo of the retail precinct already established nearby. So it's not coming soon or coming in the future. It's already there. And again, when you're looking for tenants for properties, all that kind of stuff that's just 5 minutes down the road makes a massive difference. So this is that motorway extension that we were talking about. And you can see where that cuts through all of that I guess, farm or horticultural land into the top of the city. The city's down here on the right. There's Cranford Street that it joins up with. And here we are out here this northern end of the city that's just going to fill up in terms of population because of the commuting times and the difference that will make. Okay, so all the information is in here on the website. You can see the price points and detail, and there's also the subdivision master plan for the entire location. All these are downloadable documents, so you can read and check out that information. You can see where it is on Google Maps and see the lie of the land as well. So you can see here in the SILVERSTREAM master plan how that kind of looks. You can see why we're talking about this becoming its own subdivision, a brand new subdivision next to an old subdivision, next to an old suburb, two quite different locations with details and everything that's planned there. But it's pretty cool. I mean, brand new properties as part of brand new subdivisions with brand new infrastructure, amenities, schools. They're nice to be a part of when the numbers make sense, because you just attract good tenants, good families, people who want to stay long term, people who enjoy the lifestyle, etc. Okay, so that's SILVERSTREAM. Gloucester Street, there's only 5 left in that, but again, we'll call that bread and butter. 2-bedroom, 2-bathroom in the city, walk to everywhere. The market's rising, rents are solid. The average 2-bedroom house in the inner city of Christchurch has rent of $508 a week. This has a rental assessment at $420 to $480, so it's on the conservative side. And even at that level, it's about $25 a week or $1,250 a year, positive cash flow. So just good numbers, good solid stock, good price points, good quality, well insulated, well fitted out, et cetera, et cetera, et cetera. So just good properties to invest in that will attract good tenants, professional couples, 2 couples renting it, 1 couple renting it, 2 singles, et cetera, a couple with a single, et cetera. And then let me just kill that. Sorry. And then the last one there, Addington. And again, almost all sold out now. Just one, I think, remaining out of the 20 odd. One available, 360,000. It's a small 1-bedroom property, but a price point that gets you into the market if your budget's kind of limited from that point of view. So just jumping around my screen here. So in terms of, just quickly to remind you, in terms of cash flows, these are all done on every project. So just to quickly explain or to recap, we take the 20-year growth average when forecasting capital growth into the future. Even if we know the future looks brighter, we just use a 20-year long-term growth average. In this case, 5.7%, which basically says if you buy this property today at $425,000, then in 10 years' time, it's going to be worth $739,000 or a gain of $314 based on that continued 5.7% growth. Price point or purchase prices there. Acquisition costs, we budget for legal fees, valuation fees, finance fees. You don't always have to use those. Sometimes the bank pays for those costs. We add those in so that those numbers are included. All of your annual costs are factored into the property and rising on an annual basis. Remember, this is year 1, 3, 5, 7, 9, and 10. We don't show you all the columns, so just to bombard your eyes with data. But these are the steady jumps in costs over the 10 years. So from $7,300 a year to $10,500 by year 10. Because also we start to factor in maintenance even on new properties when you probably shouldn't have maintenance. We factor that starting to kick in as the properties age, so that it's budgeted. On that bottom line there, so you can start to see $449 by year 3, almost $500 by year 5, $1,000 by year 7. You probably won't need that money with new properties, but we budget that so you've got it. Gross yield before the expenses come out, net yield before you then pay your mortgage. Net cash flow before tax. That's the money in your pocket each year after paying all of those costs, including 10% for property management. Because normally property management, of course, is quoted at 8% plus GST or 8.5% plus GST. As a residential investor, you can't claim back the GST, so it really is 9.5 to 10. So we budgeted 10 to be conservative. We put that information in there, and then we do some estimations for depreciation, which of course now with ring fencing, carries forward with the property or the portfolio to essentially reduce your tax in the future, as opposed to giving you refunds today. But the line to worry about is how am I going to fund this property? It's the cash flow line here. And then, of course, further down on page 2, we have the P&I costs if you were going to go principal and interest only. We estimate the chattels based on value information. About 10% of the building value is chattels, so things that you can depreciate: carpets, curtains, dishwashers, washing machines, etc., etc. And when we work out an estimation on that from a taxable point of view. So that's kind of what we do to make it easy for you to do all that number crunching in the background. You can download all that stuff free at the website. Take advantage of that. If you haven't requested an investment capacity report lately, you should get one, because it just basically says, based on your position today with income, debt, assets and liabilities, what 3 potential scenarios that you could achieve with portfolio growth over the next 10 years by adding 1 or adding 2 or adding 4 or 5 properties to your portfolio. We look at 3 different examples. Where could you end up based on some pretty average assumptions? And for most people, it's a bit of a wow factor, because we're really guilty as investors of not taking stock of where we're up to, how the numbers look, and then what we can do next. But the most important thing with the investment capacity report is it helps you understand, are you weak on equity or are you weak on income from the bank's point of view? What do you need to buy more of most next, i.e. faster growth or higher cash flow, so that you don't run out of borrowing power? And this report shows you exactly where you're weak and where you're strong, so you can see the gap to make sure that the next property you purchase helps to bring you more, back into balance from a bank's point of view. So request that report. We also produce property matching reports to help match properties to your financial plan and capacity, and based on what your current portfolio looks like and where you currently invest. And just immerse yourself in the website, because we spend on average probably about 100 hours bringing a project to the website. If you work back to when we first started talking to the developer and doing all the independent research on the developer and the project and the location, right down to doing all the analysis on the project for the website, it's about 100 hours across our team. So we put that time into that to make that information available. And I think on every project, there's probably about 100 pages of downloadable documentation or research or supporting information, just to save you that work. So equally, at times you'll have questions. Just don't be afraid to call our team, contact us, go to the contact page. You can call our team directly, drop us a note. Any question you have is a great question. With real estate, the only dumb question is the question you don't ask, that then causes you to make a bad decision and causes you to lose money, because you thought, I don't want to look silly asking the question, and then you decide, actually, I'm going to end up looking silly losing the money. So just ask any question. As much as we can, we try and keep this in simple language and simple terms, and not try and bombard you or bamboozle you with jargon and slogans. But if you say, I don't understand what LVR means, or I don't understand what XYZ means, or how did you come up with this number? Don't be afraid to ask. We're here to help. That's what we do. We work for our investors across the country. We're here to help you build great portfolios. If we can help you buy 5 properties over the next 10 years, so you set yourself up for your future, then we've succeeded. You're going to love us, and we're going to enjoy working with you as well. So the other thing right now is finance is taking a bit longer. So start the process early with talking to an investment savvy broker, ideally, and getting yourself pre-approved, because the process takes a bit longer. But then you're able to act faster, particularly in a market that's heating up right now. We're probably selling quickly. You don't want to end up in a situation where you have a deal under contract, and then it falls over. You can't get an extension because you need 6 weeks to get finance approved, not 3, because your accountant's not up to date or what have you. So make sure you do all that stuff, and also get the advice, speak, property management viewings. We've got a number of companies that we recommend that are independent throughout the country, that are good at what they do, that can help you to make sure you get a good result. So don't be afraid to leverage our experience and that of our partners as well. So that's the quick update tonight from the Property Factory. If you've got any questions or comments or anything you want to share, fire that through now before we wrap up. But that's what I want to share with you tonight, to give you an update on the market. And certainly, in summary, exciting times in the New Zealand market. Like most of us have, none of us would have seen these times in our lifetime, in terms of high demand, low interest rates, positive cash flow, brand new property, et cetera, and all sorts of crazy
all sorts of crazy theories about what 2021 looks like. But I'm pretty excited right now that the borders are now looking to be open before Christmas to at least between here and Australia and hopefully up to the Pacific Islands. That'll be a good start. And for all of us, if we spend a bit more time looking at our beautiful country in the next 2 years because we can't go to Hawaii or Europe or wherever you like to go, maybe that's not a bad thing in terms of the beautiful country we live in. So that's all I've got. If you've got any other questions or comments, fire those through. There's a question here from Robert. If we see a property on the website, how do we secure it? So Robert, in all of our projects, there's a button in there. In fact, let me just show you, because often sharing a picture is easier than explaining. Any of our projects, if you go into the Secure a Property Now button, if you click on that, that brings up a page called a request for contract. It's not a binding contract. It's a request for a contract. Our team will then issue you a contract for the property that you are wanting to purchase. So you enter those details down here. Which property is it? Which project? As soon as you fill this in and submit it, then we will issue you a contract that you can then sign digitally with your finger. That then goes automatically straight to the vendor's solicitor as fast as the internet can carry it, which means that once they then sign it, then you've got the property, you've got your foot on it, you've got it under control, and then you've got your 10 to 15 days due diligence to then work out finance, get your lawyer to check it, all that kind of stuff. So the request for contract is a pretty cool process because it helps our customers avoid missing out on stuff, because they wait till Monday or Tuesday and then they don't. Then by the time they ask for it, and then, you know, if you're dealing with a normal real estate agent, they'll get around to asking the developer, and then eventually you get a contract, and 2 more days go by, and if you're not careful, another buyer's come along, bought the property, and you've missed out. So the request for contract helps you to avoid that situation, because they come through to us instantly. We do everything digitally. You don't have to print out 77 pages anymore. You just sign in a couple of places with your finger or computer. And then once the vendor solicitor signed it, you've got it under control. It goes off to your lawyer automatically, and then you can get the process underway in terms of due diligence. The other thing is, and we've had a number of these, if you got 2 weeks or 10 days or 15 days, and you come into the end of it and you think, oh no, I need another week, I haven't got time, I'm going to have to cancel the contract. Just get your solicitor to ask the other party for an extension of another 5 working days or what have you. A lot of people are in the same boat when it comes to finance delays. Developers understand that. Developers know that you're not spending time and money because you want to just waste their time. It's easy to get a contract extension in almost every case if you just ask. Just don't leave it till 5:30 on the Friday, half an hour after it was due to go unconditional, because at that point, if the developer's got a backup offer waiting, they might take that instead. So give the developer a heads up 1 or 2 days out if you can. Say, hey, heads up, this is going to take a bit longer. Can we have another week? And almost in every case, you'll get an extension. We had a client in one case who had initially had a 3-week contract, and because of a whole lot of reasons that are hard, complicated to explain, but they just had a tough time between their accountant and the mortgage broker and being self-employed, et cetera, they had to ask for 6 contract extensions. So 3 weeks became 9 weeks, and then eventually they got the property under contract. It went unconditional, and they're having investors due to settle in April next year. So the developer was understanding. The process just took a while, but it came together in the end. So, you know, just a bit of advice. It's with terms like that, you know, don't be afraid to ask. So good question. Okay, so any other questions, folks, before I wrap up? Anything at all before I wrap up? Because if I have no other questions, I will let you get on with your evening, and I'll wrap up in the next 30 seconds or so. Cool. Well, thank you very much for attending the webinar. Thanks for coming on tonight. I really appreciate you putting aside an hour of your time. Take advantage of our services, and we're here to help, and we'd love to be part of helping you build a great portfolio and make some great decisions, and give yourself all sorts of lifestyle and financial choices later in life. So, folks, thank you. I will wrap up there, and look forward to seeing you online again at the next webinar or event.